Welcome back to Making Sense of Retirement. I'm John Jagay. I'm joined by Vince Oldre from CFG Retirement. Vince, good to be back with you.
Yeah, you too, Jack. It's good to see you.
So today we're talking about Roth IRAs, and this is something that I feel like is really in the news a lot. People are saying, oh, you got to do Roth conversions, get your money into a Roth, and the noise is really loud, but we're going to cut through that today. So let's start at the basics, Vince. Walk me through, what is a Roth IRA?
Yeah, it is a really hot topic right now, and it is something that we should all be looking at because of where taxes may go in the future. So the benefit is a Roth IRA can be more tax efficient, especially in the future. So you have an IRA or a 401k, which most people save the retirement funds in. That money grows tax deferred, right?
Meaning you don't pay the tax now, you pay it later.
Correct. The difference with a Roth IRA is you pay the taxes up front, but then it gets to grow tax-free.
Got it.
Okay, so you'll never pay taxes on it again. Now, you might be saying, hey, well, I don't have to pay taxes on my bank account. Well, the only reason why it's true right now is because there's no interest on your checking account, so you're not really paying any taxes on your checking account right now.
Got it.
When you did have interest in your savings and checking, you did get a 1099 for that interest, which then means you would have paid taxes. But, I mean, we're not paying like taxes on 10, 15 cents lately, so there's a big difference between your checking and savings account, what kind of interest you're getting there compared to a Roth IRA, which, again, when the money goes in there, you have to pay the taxes when it goes into that account at whatever tax bracket you're in. So if you're at the 12, you pay 12% taxes and then never pay taxes on it again. Now, there are some caveats. If you want to take money out of it, you have to be 59 and a half or older to take money out to receive that tax-free benefit. But also just keep in mind, any money that you do put into it up front, you've already paid the taxes on. So if you take the principal out, you won't have to pay taxes on the principal again if you had to take it out early.
You're going to pay the taxes once. The difference is in a traditional Roth or IRA, you're paying it later. But when you do a Roth, you're paying it on the way in instead of the way out. Do I have that right?
Exactly. So it can be very tax efficient if you think about where taxes are now, right? Would you rather pay 12 or 22% now and not pay what it might be in the future, 25, 30, 35, 40, maybe 50%, depending on what tax bracket you're in now and what you might be in the future? Or sometimes it makes sense to do when you actually retire because you were told you're going to retire in a lower tax bracket once you do retire because you have less income. However, that may not necessarily be true if you think about where taxes are right now.
And the proverbial wisdom there is that taxes are historically low right now. And with the amount of money the federal government has spent on the pandemic and infrastructure and other things lately, they've got to pay for it somehow. So while we don't have a crystal ball and we can't guarantee it, a lot of indications are that taxes are headed up.
Exactly. So we've always been told to defer, right? Defer your tax payment until you retire because when you retire, you will be in a lower tax bracket. Now, what's kind of happened over that 30, 40-year period that they've been telling us to do that over and over, taxes actually have come down over that time frame.
Yeah.
So here we are, all of a sudden the script has flipped a bit, right? So we have to think about how do we move things now before taxes do go up? And that's where a Roth conversion comes in. And if you're like, well, geez, I'm about to hit retirement, or I'm already retired, I can't do a Roth IRA anymore, right? Because it's too late. Well, that's not true. If most of your money is in an IRA or 401k, you can still do what's called a Roth conversion, where you convert the money from your IRA or 401k over to a Roth IRA. The caveat, again, is that you have to pay taxes when you make that conversion. So you want to do this strategically and tactically. You don't want to just move everything all at once. You do want to move things tactically where you try to stay within a tax bracket you're comfortable with. So I can give you an example. Let's say you're married and the top of the 12% tax bracket is somewhere around $80,000 and you want to move money within the 12% tax bracket. Well, if you make $60,000 between you and your spouse, then you have about $20,000 of wiggle room. Now, keep this in mind that you still have your standard deduction, so you can add that into the numbers too. So if you subtract, the $20-some thousand for the standard deduction, you can move maybe up to $40,000 and stay within that 12% tax bracket. Now, before you do anything here, okay, we're talking about taxes. Please make sure you meet with your CPA or tax advisor to make sure it is a good idea,
right?
Or with your financial advisor, because anytime you do something like this, it's now permanent. Okay. You can't change your mind. Once you move the money, it's a done deal. So you don't want to just willy-nilly throw the money over because you heard us on our podcast here. You want to make sure you are meeting with someone just to go over the numbers. Look at the numbers before you do the conversion. Now, the benefit of doing this is now that we moved money at the 12% tax bracket, we don't have to worry about that money in the future. That money is now tax-free going forward. So I paid my 12%. I'm done with it. Never have to pay taxes on it again as long as I follow the simple rules, which is, again, I can't touch the gains for up to 5 years. But once you're past that, this is a longer-term vehicle anyway. So once you're past that, everything's tax-free. You don't have to worry about taxes again with it. So the idea, again, move money now while things are tax efficient before tax rates go up.
The idea is you want to pay the lowest rate of taxes you possibly can on this money that is set aside for your retirement. So if that means paying it now when you know what that tax bracket is versus if you think you might be in a higher tax bracket later and only doing a little bit at a time, maybe if that'll keep you within that same tax bracket. The whole idea here, Vince, if I'm understanding this right, is to move the money at the most tax efficient time, meaning paying the least amount of taxes on it possible.
Exactly. And some of this is up in the air, right? We don't know exactly what taxes might go to in the future. I don't really see them going down.
Right.
But I'd see them probably going up a little bit. Would that mean more of the 12%? Will that change to the 15? Would the 22 go back to the 25? Yeah, I don't know. But again, they haven't been this low in a long time. Now's the time to take advantage of what we say is taxes are on sale. And we all want to pay our fair share.
Yeah.
We're all patriotic here. We're willing to pay our taxes. That's not the point here. Your money to last in retirement means it needs to be efficient, right? So by saving some money, by saving money on taxes, that means your money can last longer. And the other benefit to it is when you do leave the money to your beneficiaries, they get that money tax-free.
Right.
So there's some added benefit. If you don't use all your money, they will get that tax-free as well. Now, it's not going to be estate tax-free, but it will be income tax-free since you already pay the taxes on it.
And so the important thing to remember, too, is once you convert over to a Roth and you've changed that money over and you've paid the taxes on it, not only are you not paying the taxes on the way out, but any growth you have of that money that you've already paid the taxes on is going to grow tax-free, correct?
Exactly. And I want to give you a quick strategy as far as going off of what you're saying there. Think about if you have IRAs or 401ks and they're growing, you also have something called required minimum distributions in the future.
Yep.
Which means you have to pay taxes on your 401ks and IRAs eventually. You don't with a Roth IRA. So here's where some of the stuff can come in. If you move enough money over to a Roth IRA and keep your income tax level down, you can actually make more of your Social Security tax efficient too. And the reason why is because Social Security is taxable based on certain income levels. And it can get rather complicated. But what you're starting to probably realize is, oh my gosh, everything's being touched by my retirement assets and taxes, right? Social Security, your 401ks, your IRAs, anything that you touch for income is going to possibly change how everything is going to be taxed. So it's not necessarily like, oh my gosh, you have to make things completely tax-free. Maybe it may make more sense to at least move some of the money to lower your overall tax level to make maybe your Social Security more tax efficient or tax-free. So there's a lot of different things or a lot of different strategies that you can implement. Maybe moving everything to tax-free is not your strategy, but maybe making things tax efficient for you or keeping you at least below that bracket, or when you have required minimum distributions, keeping you below the 12% going forward or the 22%, or if things rise, you're still going to be lower or put lower in those lower brackets. That's probably what's going to keep you from running out of money sometimes, or making things efficient or leaving more money behind.
The number one fear of retirees is not dying, it's outliving their money. So every available avenue you can have to stretch your retirement income as far as you possibly can, and that includes being tax efficient, is an absolutely good strategy. And as you said, Vince, this just depends on everybody's individual situation. It's not for everybody. And I got to imagine there are probably times when a Roth conversion would not make sense, right?
Yeah, I know when we talk about this, especially when we teach our classes, everyone comes in and says, I want to do a Roth conversion. Well, we do have to take a few steps back, right? And make sure it does make sense for you. Sometimes, like if you don't have a lot of money, it may not make sense. If you're already in a low bracket, will always be in a low bracket, it may not make sense. The other thing to note, though, is maybe you might be looking at doing Roth conversions too early. Maybe you're making too much money right now and you should wait till you retire to do the Roth conversions. Mm-hmm. Now, I know some of you are antsy to do the Roth conversions because you're worried about taxes increase in the future, but just try to hold off if you can and look at your individual situation. And then sometimes when we look at it, you find yourself, well, you're going to be in the same bracket regardless going forward, and you might have maybe a large pension, and we're going to be stuck in that bracket. It may or may not make sense really to do it. And all I can really say there is it really is just based on each individual situation. You have to look at your own numbers and figure out where you might land in the brackets, what type of assets you have, what your requirement of distribution might look like in the future to see what might force you into the next bracket. Is that going to make Social Security more taxable for you? So there's a lot of different things you should look at and figure out where things might go instead of just, you should do it because you have this much money. One thing just to note, when we think about all that, you need to actually put a financial plan together or retirement plan, which means you have to look forward planning. When you meet with your CPA or your tax advisor, they aren't always looking forward, right? They're usually looking at what did you do last year,
right?
Not what's going on next year, 5 years, 10 years down the road. That's where true financial planning comes in. Typically, a CPA or tax advisor is just, here's what your 2020s looked like, and they won't mention you should have done a Roth conversion. It's too late.
Yeah.
That does bring up some other points too. When can you do a Roth conversion for it to apply for 2021? Well, you have to do it by the end of December 31st. If you do a Roth conversion after that point, then it's going to count for 2022. So you have to do tax forward planning to really make it work. Otherwise, it just doesn't work.
This is why everybody's individual situation is different, why you need to talk to a professional, why you need to talk to a financial advisor. Vince, if someone wants to come talk to you at CFG Retirement Group, what are the best ways to find you?
Best thing is actually go to our website, cfgretirement.com. You can give us a call or look us up there. Mike and myself are in the office. We're willing to help you out. If you want to run through different strategies, what we do is we run you through a program where we can look at whether you should or should not do a Roth conversion, what those numbers look like, should you take Social Security earlier or later, what your requirement distributions might look like, your cash flow. Everything is going into what we call the retirement plan. Again, go to our website, cfgretirement.com, or give us a call at 952-657-7470. Again, 952-657-7470.
We'll have all of Vince's contact info in the show notes. Thanks as always for being here, Vince, and we'll talk again soon.
Yep, thanks, Jack.
Investment advisory services offered through Assured Retirement Financial Group, Inc., a registered investment advisor in the state of Minnesota. Insurance products and services are offered through CFG Retirement Group, Inc.